Hey everyone, now we will be solving another example related to the disposal of non-current assets. So let's begin. The question says a business maintains its non-current assets at cost, okay, and provision for depreciation accounts are kept separate, right. Now we have the information regarding the date 31st December 2019. The position was as follows, okay. Now we have the total cost to date for machinery and for office furniture. So there are two non-current assets in this question, and we have the total depreciation to date. So this means that this is the depreciation and this is the cost at 31st December 2019. So this means that for January 2020, these balances will become the balances brought down for cost and for the accumulated depreciation. Okay. Then we are told that there are following additions which were made in the current year 31st of December 2020. We have purchased machinery costing 16,000 and office furniture costing 460. So these are the additions. Right. We know that the additions are shown on the debit side of the non-current asset account. Okay. Then we are also told that a machinery bought in 2016 for $1,600 was sold for 360 during the year. During which year? During the year 2020. The cost of this machine was 1600 and this is the 360 is the disposal proceeds. Okay. So in the current year we are purchasing machinery as well as we are selling machinery as well. Then we are told with the rates of depreciation, machinery 20%, office furniture 10%, and the policy is, the method is straight line basis, and the policy is calculated on the assets in existence at the end of each financial year irrespective of the date of purchase. So this means that full year or monthly, this is the full year policy and the method is straight line method, right. Now the first requirement is to prepare the machinery account, of course at cost, then office furniture account, then the depreciation account for these two assets, then we have to prepare the machinery disposal account as well, and lastly the SOFP extract as at 31st of December 2020. So let's begin with the machinery account. First we know that this is the cost account, so we will start with the cost balance brought down, and that is given to us 94,500. Then there are additions during the year and there is a disposal as well in this question, right. So this is the format of non-current asset account. The current year is year 2020. We have the balance brought down on January 1st amounting to 94,500. Then during the year, let's suppose December 31st, we are purchasing additional machinery through cash, the price of which is $16,000, and there is a disposal during the year as well. Let's assume December 31st disposal, right. The cost of this disposal is $1,600. Okay. So we know the double entries. Disposal account will be debited with the cost and the non-current asset cost account will be credited with the value, right. So that's it, no more additions or subtractions. We can now easily calculate the balance carried down figure, and that would be 94,500 plus 16,000 less $1,600, right. So balance CD would be 108,900 and the totals will be 110,500. That's it. We just now have to show the balance brought down for the next year, January 1st 2021. The balance brought down will be 108,900, right. This balance represents what? It represents the additions which were made during the last year and the subtraction, right. So we have subtracted the cost of the asset that we have disposed of and we have added the cost which we have purchased in the last year, right. So we are done with the first requirement, and that was to prepare the machinery account. Now let's move to the office furniture account. In office furniture we just have the cost and we have the additions amounting to $460. There are no disposals for office furniture, so that's easy, right. Again we'll start with the balance brought down 2020 January 1st balance brought down is 3,200 and there's a purchase. Let's assume at last date December 31st amounting to $460, right. This will give us a balance CD figure of at 31st December 36 3660 and totals of 3660 as well. Lastly, we just have to show the balance brought down for the next period. January 1st, 2021, balance brought down 3660. So, we are done with the second requirement as well. Now, we have to move to the third one, which is the provision for depreciation of machinery account. Right, and in machinery we know that there is a purchase as well as there is a disposal. What is the policy? The policy is straight line method, 20% on machinery, 10% on furniture, and this is a full year policy. Okay. So, in this question we were not given with the date of disposal, and that is again not required as well in order to calculate the accumulated depreciation on this asset, because this is a full year policy, and we know that since this asset did not exist at the end of 2020, so there will be no depreciation calculation on this asset for the current year, right. Rather, for how many years we will be calculating the accumulated depreciation on this asset? We will start from 2016, right, because this was the year of purchase. So, 2016, 2017, 2018 as well, and 2019. So, in total 4 years. Accumulated depreciation will be calculated for 4 years on this asset which is being disposed of in the current year, right. So, let us do the calculation. This is the account for provision for depreciation machinery, right. So, first we will start with the balances brought down. 2020, both the sides we know that the balance brought down for the provision for depreciation is written on the credit side. So, balance brought down for machinery, and what was the balance? The balance is 28,350 for machinery, and for office furniture it is 1280. So, 28,350 on the credit side, right. Now, how many entries will come in this account? We know that there will be a current year depreciation charge December 31, right, written on the credit side with the name income statement. Then there will be 2 more entries on the debit side. Firstly, the accumulated depreciation, which we will now be subtracting from this account. In other words, we will be eliminating the accumulated depreciation on this asset which we are disposing of in the current year, right. And lastly, on the same date there will be the balance carried down figure on the debit side again, because it is a contrast. Okay, so first things first, let us first calculate the accumulated depreciation on the asset which we are disposing of in the current year, right. The cost of this asset was $1,600, and we have concluded that we will be calculating the accumulated depreciation for 4 years on this asset, right, using the straight line method, 20% depreciation. So, let us do that. The asset which I am now disposing of, so accumulated depreciation, the cost is 1600, and the policy is to charge depreciation of 20% every year, right. So, 1600 multiplied by 20% would be 320, but that is per year, and we have to charge depreciation for 4 years, right. So, 320 multiplied by 4 would be $1280. This is the accumulated depreciation on this asset for 4 years. So, this will be debited in the provision for depreciation account, as I am now eliminating this accumulated depreciation, right. Now, I am left with the balance CD figure and the income statement figure. So, we know that first we have to calculate the income statement figure, which is what? The current year depreciation charge. Now, how can we do that? We know that in the machinery account we have 3 entries. First one was the balance brought down, then there was a disposal, and there is a addition as well amounting to $16,000. So, basically we can calculate depreciation on this asset if we are following the straight line method and the full year policy in 2 ways, right. Now, let us do both of the ways so that you get an idea that how do we go about it. The first method, in first method we will charge depreciation separately on each of these assets, right. So, first we will take the balance brought down, and that was how much? That was 94,500, right. Then you subtract the disposed of asset during the year which had a cost of $1,600, right, because first I am charging depreciation on my old assets, right. Then I will charge depreciation separately on my new asset as well, but for that I have to eliminate this balance so that I do not overstate my depreciation charge on my old assets, right. Then we will multiply it with the depreciation rate, and that is 20% in this question, which will give me a figure of 18580 depreciation for current year, and that too on the old assets. Then I will charge depreciation on my new asset, which had a cost of $16,000 multiplied by 20%, and that too fully a policy, so you don't have to prorate it, and the months are also not given in this question, so there is no need for that, and that would be $3,200, right? So this is on old assets, this is on new assets. The accumulated figure for current year depreciation would be 21780, right? Old and new asset. There is another way as well in which you can calculate depreciation if you are given with the straight line method and the full year policy, right? And that is by directly taking the balance carried down figure and multiply it with the percentage rate, right? Why am I doing this? Because I know that since I am not following the monthly basis policy, so there is no extensive calculation required to calculate depreciation on this asset, right? I don't have to prorate it. So this balance represents the assets present at the end of this accounting year, that is 2020, and since I am following the straight line method, so I don't have to separately minus or subtract the accumulated depreciation on each of the assets, right? If I had been following the reducing balance method, I would first have to subtract the accumulated depreciation from the balance brought down, right? And that too, which balance brought down? 94,500 less 1,600, and then less the accumulated depreciation, and then apply the rate, and then separately charge depreciation on this asset as well. But you can accumulate that as well, but for that, if I am following the reducing balance method, I first have to subtract the accumulated depreciation. But since we are following the straight line method, so we can directly use this figure 108,900, and we can charge depreciation on this. But this is again possible if we are not given with the reducing balance method and the monthly basis policy, right? So 108,900 multiplied by 20% would again give the same figure, and that is 21780, same as the one we calculated for method number 1, right? So this is what, this is the current year depreciation charge, 21780. So we have calculated 3 figures, we have inserted these 3 figures, we just now have to calculate the balance CD figure, and that would be 28,350 plus 21,780 less 1280, and that would be 48850. The totals will be 5130, 5130, and then lastly, don't forget to bring down the balance for the next period. So 2021 January 1st, balance brought down on the credit side 48850. Okay, so this was easy. Right now we are left with the office furniture provision for depreciation account for 2020. So January 1st, balance brought down, and the balance for office furniture depreciation given in the question is 1280. So 1280 on the credit side. Then again there will be now 2 more entries, right? Because there is no disposal for office furniture, so there will be just the income statement entry and the balance CD figure entry, which would be the accumulated figure of balance brought down and current year depreciation, right? So how will we calculate the current year depreciation? What is happening in office furniture account? In office furniture there was the balance brought down, of course, and then there is a purchase of $460. So there are no disposals, we are following the straight line method, we are following the full year policy. So again we can benefit from this, and we will do less calculations, that is just take the balance CD figure and multiply it with the rate, and that is 10% in this question for office furniture. So the balance CD figure is 3660. 3660 multiplied by 10% will give me my current year depreciation, and that would be 366. This is the depreciation on old as well as on the new asset. So 366 will be written on the credit side, and then I'll have my balance CD figure and my totals as well, which would be 1646. Lastly, balance brought down January 1st, 2021 on the credit side 1646. So we are so far done with how many requirements? We are done with A, B, C and D. Now we are left with 2. First of all, the machinery disposal account, so that we calculate whether there is a profit or loss on disposal, and lastly the SOFP extract for the current year. So let's do that as well. Here we have the machinery disposal account. We know that how many entries come in this account. There can be 3 or there can be 4 as well. There can be 3 if there is a no profit, no loss situation. However, if there is a profit, then there will be, or loss, there will be 4 entries. So let's begin. The year is 2020 and we are selling this asset, let's say on the last date. So the cost will first of all come on the debit side, and that is machinery account, the cost account, right? This was at cost. So the cost of asset which I disposed of in the current year, it had a cost of $1,600. Then what else? The accumulated depreciation, of course. So provision for depreciation, we calculated on this asset for 4 years, and that was how much? That turned out to be $1,280. So this is the accumulated depreciation. This will be written on the credit side because it falls on the debit side in the provision for depreciation account. Then the disposal proceeds, let's say it was received in cash and we were told this value in the question, which was how much? It was $360, right? So 360 again on the credit side because this will be debited in the cash book. So now we just have to calculate the profit or loss on this disposal. So on the debit side we have a total of 1600, and on the credit side 1280 plus 360 is 1640. This means that the shortfall is on the debit side, and whenever there is a shortfall on the debit side, this means that there is a profit on disposal. That is $40. So there is a profit, there is a gain on disposal of $40 in this question. And what does this 40 represent? This means this represents that the cost of this asset was 1600. However, it had been depreciated by the time of its disposal by 1280, and still the business managed to sell it, this asset, over and above its net book value, right? By how much? By $40, because this asset at the time of disposal, what was its net book value? The net book value was 1600 less 1280, $320. However, it was not sold less than its net book value, but rather by more than its net book value, and that was by how much? By $40. If it had been sold at less than its net book value, let's say 310, then there would have been a loss on disposal. And if it had been sold at this value, that is 320, so there will be a break even, or let's just say that there will be no profit, no loss. Okay. Now we are left with the last requirement, and that is to prepare the SOFP extract. So let's begin. Okay, so this is the format which you can follow in exam as well, and this will take and this will save a lot of time and your space in the question paper and the booklet given to you, because you don't again have to write the less accumulated depreciation and then the net book value, and as that you can do all at once. Okay, so we know that what figures do we take in the SOFP extracts? The balances CD figures, because statement of financial position is prepared at a particular date, right? So for machinery, in which account will I go? I will go in my cost account, and same for office furniture as well. Then I'll go in the provision for depreciations account, so that I have my net book values, right? So for machinery, the balance carried down was how much? It was 108,900 for machinery, and for office furniture it is 3660. So let's write that down. 108,900 for machinery and 3660 for office furniture. Then I have to check my accumulated depreciations, right? So machinery accumulated depreciation is how much on the debit side? 48,850, and office furniture it is 1646, right? So 48,850 and 1646, right? Now what else? I just have to calculate the net book value, and that is cost less accumulated depreciation. So net book value for machinery is 60,050, and for office furniture it is 2014. So I hope that by now you will have a good understanding of how do we go about disposals in question, how do we calculate the accumulated depreciation on the asset that is being disposed of in the question, whether it is a full year policy, monthly basis, reducing balance method, or even a straight line method, right? So that's it for this video. I'll see you in the next one.